Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive.
We've got a really special one today.
We absolutely do. Today, we're breaking down a company that, honestly, is one of the most unique and, frankly, controversial names in the entire market. We are talking about Texas Pacific Land Corporation, ticker TPL.
And it is a fascinating case study.
On the surface, it looks like a simple energy play. But the real question for us as long-term investors is this. Is TPL the ultimate fortress with an unbeatable moat? Or is it a reflexive bubble where the story's gotten so good that the price is completely detached from reality? That's what we're here to find out.
That's a massive question. And before we get into the details, just a quick note for everyone watching.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use interactive brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time. That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel. And if you have any questions regarding the company, please manifest yourself in the comment section.
Perfect. Now let's get into it. Pillar number 1, the business model. Just what is TPL?
Okay, let's unpack this and provide the necessary foundation.
Huh.
For anyone who only knows TPL as a headline ticker, let's define the business engine. What exactly is TPL?
Right.
Why isn't it just another oil company? And what gives it this incredible, this unreplicable business engine?
It's an extraordinary case, and you can feel the tension right from the start. TPL is often mistakenly considered just another energy sector play because of its enormous exposure to the Permian Basin.
The biggest oil field in the U.S.
Right. But the financial metrics, they suggest something completely different, something closer to a unique monopoly utility.
Monopoly.
Our core mission today is to resolve this tension for you, the listener. Is TPL truly the ultimate cornered resource? A business with an unbeatable, unreplicable economic moat? Or is its current stock price symptomatic of a reflexive bubble where the narrative of scarcity and quality has dramatically, decoupled the price from the underlying fundamentals?
And the data snapshot confirms that immediate shock value. I mean, especially if you try to pigeonhole TPL as just an exploration and production or E&P proxy.
It just doesn't fit.
Look at these eye-watering numbers. We're talking about a trailing 12-month price-to-earnings ratio of 45.1 times.
45 times earnings. Let that sink in for just a moment. This is a business whose fortunes, despite all its defensive qualities, they're intrinsically tied to commodity price cycles.
Of course.
So when you compare that PE to the broad energy sector average, which historically hovers around, 10 to 12 times?
Yeah, about that.
You immediately grasp the staggering magnitude of the premium the market is applying here.
It's a fourfold premium.
The market is giving TPL a fourfold multiple premium over its peers. It's essentially pricing it as a scarcity asset, not a cyclical one.
And it gets wilder when we look at the enterprise value. The enterprise value to EBITDA metric is floating around 35 times.
35 times EV to EBITDA.
To give that some context for you, that multiple is usually reserved for high-growth, asset-light software-as-a-service companies.
Right, your top-tier cloud providers.
Exactly, the ones growing 30–40% per year. The fact that TPL, which is essentially a land-holding and royalty collection company, is priced this way, it tells you there is profound embedded optionality being banked on by shareholders.
Absolutely. The valuation is not pricing the current cash flows.
No.
It is pricing the perceived monopoly power of the future. And this is further evidenced by the free cash flow yield, which sits at a measly 2.1%.
That is low.
If you look at a FCF yield that low, you are accepting a return that suggests the market believes TPL has massive internal high-return reinvestment opportunities ahead.
Right, like a growth company.
It's treating it like a company that is going to reinvest and grow rapidly, despite the core asset having been owned since the 1880s railroad grants. It is the ultimate tension point. High-quality asset, extremely high-growth valuation.
Okay, let's unpack this. What exactly is the business?
TPL is fundamentally the ultimate, most passive landlord of the Permian Basin. Think of them as a royalty tax collector.
A tax collector.
It was born from historical land grants given to the Texas and Pacific Railway Company back in the late 19th century.
So this is old, old land.
Ancient in corporate terms. And crucially, they do not take on the exploration or development risk, unlike the E&P companies.
So they're not drilling.
No. They simply own the surface and mineral rights across approximately 880,000 acres in West Texas. It's a vast empire of passive income generation.
880,000 acres. That's a staggering amount of land. It's nearly the size of Rhode Island.
It's enormous.
So how does this translate into what the analysis calls their black box unit economics?
Think of it as the ultimate passive income model. The E&P majors, your Chevron, your Exxon, Occidental, they deploy billions of dollars of capital.
Right, all the risk.
They hire the geologists, manage the drilling crews, deal with all the operational logistics, and handle the steep capital expenditures. TPL just waits for the check.
Just sits back and waits.
They collect a predefined contractual royalty on every single barrel of oil and every cubic foot of gas produced on their land.
And what's the typical range of that royalty? What are we talking about?
It can vary widely depending on the lease terms, but we see ranges typically from, say, 1128th up to maybe 116th the production.
That's a huge range.
It is, but the key is that the heavy lifting, the immense capital expenditure, the operational headaches, that all belongs to someone else. TPL just owns the land and the rights beneath it.
This passive ownership leads directly into why TPL is often heralded as the perfect inflation hedge. Help us understand the numerical mechanism behind that, the margin expansion.
It's beautiful in its simplicity. When the price of oil or gas rises, let's say crude goes from $70 to $90 a barrel.
Okay.
TPL's royalty revenue increases linearly with that price change, immediately.
So it's a one-to-one relationship.
Yeah, but here is the financial magic. Their operating costs, which are required only to maintain ownership of the land and a small corporate office, do not increase proportionally with the commodity price.
So their fixed costs remain largely stable while their revenue spikes dramatically because of the higher price of the commodity.
Exactly. This combination of linear revenue growth against zero marginal cost increase creates an immediate dramatic multiplier effect on their profitability and cash flow.
It's a mechanism that's almost impossible to replicate in an active business.
Almost impossible. It makes TPL's margins incredibly resilient and volatile, only to the upside when prices rise.
That structural advantage leads us right into the discussion of their moat. We categorize this as a cornered resource. Explain why this asset is considered chemically unique and legally protected.
Because it is literally non-replicable. You cannot go back in time to the 1880s and acquire 880,000 acres of contiguous or near-contiguous land in the most productive oil basin in the Western Hemisphere.
It's a historical accident, basically.
A very profitable one. The moat is a legal and geological artifact. It is not based on superior software or brand recognition or network effects.
No.
It is a physical and legally protected corner on the map. They own the finite resource.
And what's interesting is the analysis suggests this moat isn't static. It's actually widening because of modern drilling technology. Now, that seems counterintuitive. How does advancing drilling technology benefit the landlord who isn't doing the drilling?
This is the genius of their original unique ownership structure. It's often referred to as the Checkerboard or Checkerboard land grants.
Okay, what does that mean?
TPL's holdings are not one giant solid block of land. They're interspersed with land owned by others, creating an alternating pattern like squares on a chessboard.
I see.
And as drilling technology has advanced, specifically the ability to drill incredibly long horizontal wells, we call them 2-mile or 3-mile laterals.
Right.
The economics change dramatically for the producer.
So why do 3-mile laterals change the game for TPL?
Well, the longer the lateral, the more oil they can access from a single surface location, which significantly lowers the producer's cost per barrel.
Makes sense? More efficient.
But to drill a 3-mile lateral, they have to traverse a vast geographical area underground. And because TPL's land is checkerboarded across the basin,
It becomes statistically impossible for them to operate without crossing TPL land at some point.
exactly. Even if TPL only owns a small slice of the underground path, that slice triggers payment.
So if you want to access the lucrative oil 3 miles away, and TPL owns the right-of-way in the middle of your path, you have to pay the toll.
Precisely. This leverage immediately grants TPL absolute pricing power in the Easements segment, which is wrapped into their water services division.
Okay, and this is where the moat really shines.
It really is. If a producer needs to lay a pipeline to transport crude or, more commonly, water, and they will need to, they have to pay TPL's toll for the easement.
And there's no alternative route.
For many critical pathways, there is genuinely no viable alternative route. They have a monopoly on the path.
So they are not just making money on the oil royalty, the mineral rights. They are making money on the infrastructure necessary to move the oil and, increasingly, the water, the surface rights.
A multi-layered income stream from a single piece of dirt.
And with monopoly pricing power on the infrastructure side.
A fee for the easement, a fee for sourcing fresh water for fracking, and a fee for disposing of the produced water. This is why analysts don't treat them as just an energy company. They're a utility-scale surface logistics provider.
That's a phenomenal breakdown. If the asset quality is that high, we need to understand the converging forces that amplify this power. The analysis mentions the Lollapalooza effect.
Right.
Can you break down those three converging forces that make TPL such a unique outlier?
The Lollapalooza effect. It's a term often used to describe when multiple independent positive factors converge to create an outcome greater than the sum of its parts. For TPL, we see three powerful reinforcing forces at play that increase both their earnings and their multiple.
Let's start with the physical reality of the oil market.
Okay, that's geological scarcity. Despite all the attempts and exploration dollars spent globally, the Permian Basin remains the single last major, highly productive growth engine for U.S. oil and gas production.
So other fields are drying up, relatively speaking.
Exactly. Other major shale plays, like the Bakken in North Dakota or the Eagle Ford in South Texas, they're maturing. They're entering structural decline phases, or at least flattening significantly.
And that means?
This decline elsewhere means the remaining available global capital is concentrating disproportionately on the Permian.
So as other shale plays decline, the Permian's relative importance, and by extension, the strategic importance of its ultimate landlord, only increases.
Precisely. It drives continuous, concentrated drilling activity on TPL land, regardless of short-term volatility.
Okay, factor two.
The second factor is related to policy, regulatory capture. This is critical to the water business.
Oh, the water business again?
Water disposal is a gargantuan issue in the Permian. As environmental and regulatory scrutiny increases, especially regarding seismicity linked to deep well injection.
Earthquakes.
Yes, earthquakes. It forces producers to rely heavily on existing, permitted, large-scale surface solutions for produced water.
And I'm guessing TPL owns those permitted surface solutions and disposal capacity.
They do. Restrictions on disposal elsewhere push more produced water volume directly into TPL's orbit, solidifying their water monopoly.
So regulation, intended to limit environmental impact, inadvertently raises the barrier to entry for TPL's competitors.
It strengthens their pricing power by narrowing the competitive set to, well, almost zero.
That feels like a dangerous reliance, though. If TPL gets too much power over essential infrastructure, couldn't producers or regulators eventually mandate alternatives?
That is the perpetual political risk. It's a reason the multiple probably shouldn't be 45x. But the geological reality protects TPL. How so? While eminent domain is possible, building a competing, permitted, geographically integrated water infrastructure network from scratch is prohibitively expensive and time-consuming. TPL is grandfathered in.
They have the permits, the locations.
And the rights of way established over decades. The short-term economic choice for a producer is always to pay the TPL toll, even if they resent it.
Okay, what's the third factor in the Lollapalooza effect? The market dynamic.
Financial reflexivity. Because TPL exhibits such high business quality, pristine margins, and a unique asset class, it naturally attracts the attention of large, long-term institutional capital.
You mean passive indexing and ETF flows?
Exactly.
Wait, TPL is an established company that requires minimal external capital. How does ETF flow help them other than just driving the stock price up?
The rising stock price itself creates a virtuous loop. A high valuation signals stability, quality, and scarcity to the broader market. That attracts more passive money.
As index funds are forced to buy more.
Right, which drives the price up further. This reinforces the safe haven narrative and separates it from the volatility of lower quality energy peers. It becomes a self-fulfilling cycle of multiple expansion.
Speaking of institutions, we have to address the governance structure. TPL underwent a major change, transitioning from an opaque trust structure to a modern C-Corp.
Yes, after a pretty bruising proxy battle in 2023.
This was more than just paperwork, right?
This shift was incredibly important for attracting a new class of institutional investors. The trust structure was a historical relic that lacked modern shareholder protections and operational transparency.
So who's behind the fight?
The battle involved activist investors, notably Horizon Kinetics and SoftVest, who rightly argued that TPL was stifling its own institutional appeal.
And what was their core argument?
They essentially wanted TPL to stop acting like an antiquated, family-managed estate and start acting like a publicly traded, shareholder-friendly company.
Makes sense.
The trust structure made it difficult for institutions to acquire significant stakes and gave immense power to the trustees. The transition to a C-Corp dramatically improved governance.
So it instituted a formal, independent board.
Right, and aligned management incentives with modern corporate standards.
And this shift solidified the owner-operator mindset.
That is the key cultural outcome. When you have an owner-operator mindset, the board views TPL as a generational asset, a 100-year hold.
100 years.
They're focused on maximizing the value of the asset over decades, not quarters. They are not incentivized by short-term vanity metrics or the need to hit analyst consensus every 3 months.
So it's the opposite of the typical manager's quarterly sprint culture.
Exactly. They understand that since the asset is irreplaceable, disciplined stewardship is their highest goal.
That disciplined stewardship brings us to part 3. How does this superior business quality translate into cold, hard cash flow?
This is the moment of truth.
It really is. The asset-like claims get tested here.
We need to run TPL through the quality of earnings test, and it passes with flying colors that should make any CFO jealous.
Okay, where do we start?
Start with the margins trajectory. Gross margins are consistently above 85%, with EBITDA margins hovering near 80%.
Help me reconcile that. How does an oil-exposed royalty company achieve margins that are superior to even top-tier enterprise software providers like, say, Microsoft or Adobe?
It goes back to the core landlord model. TPL has virtually zero cost of goods sold, or COGS in the traditional sense.
Okay.
A software company has massive R&D expenses, customer acquisition costs, hosting fees, high salaries for developers.
Right, a huge cost structure.
TPL's only real costs are administrative legal fees and minimal operational costs for their small water segment. They don't have to pay for the expensive drilling, the well maintenance, or the labor.
So that inherent cost structure is what drives these incredibly high, stable margins.
Margins that are truly scarce in the physical asset world.
Let's talk about a huge hidden drag on free cash flow for those high multiple tech companies. Stock-based compensation, or SBC.
Yes. This often quietly eats away at cash flow.
What's the reality check for TPL on this front?
This is a critical point that the market largely ignores when they compare TPL to tech growth stocks based on multiples. For many high-flying compounders, SBC can consume 20 to 30% of operating cash flow,
Quietly diluting shareholders.
and masking the true cost of labor. For TPL, SBC is negligible. It's typically less than 2% of operating cash flow.
Meaning that when TPL reports free cash flow, it is genuinely real, distributable cash.
Exactly. There's no major hidden expense forcing them to issue new shares just to compensate management for hitting targets. The incentives are aligned with actual cash return.
And the conversion ratios.
Their FCF conversion ratios are the gold standard. FCF to EBITDA is consistently above 80%, and FCF to net income is often near 100%.
And that's the ultimate proof of the asset-light model.
It is. They have minimal maintenance capital expenditures required to keep the business running because the asset, the land, requires very little ongoing CapEx.
Now that we know they generate mountains of real cash, the challenge becomes capital allocation. The CEO's report card suggests management is acutely aware that they have a structural constraint.
A big one.
They cannot reinvest internally at a 20 or 30% return rate because they simply can't buy more land at 1888 prices.
That's the core conundrum for any pure royalty play. Once they have the land, the only truly rational financial decision is disciplined capital return. Their cash deployment hierarchy is crystal clear.
And it prioritizes the shareholder over empire building.
Completely.
So how does that discipline manifest itself in actual cash deployment? What are they doing with the money?
Their primary tool is the special dividend, not leveraged buybacks at elevated prices. In 2024, they paid a massive $10 per share special dividend. They were effectively saying, we cannot deploy this cash internally at a high enough rate to justify keeping it, and we are not buying back stock when the multiple is 45x.
That is the financially rational, disciplined move. Deploying cash into value-destructive buybacks when the stock is already expensive hurts long-term shareholders.
It absolutely does.
But doesn't that capital discipline refusing to engage in aggressive buybacks create a risk of the market punishing them for not maximizing leverage and growth, especially when that multiple demands it?
It's absolutely a challenge, and it requires a certain degree of confidence in the long-term compounding story. Management chooses to be fiscally conservative.
So they're building a fortress.
A fortress balance sheet. They target a robust $700 million cash balance, providing massive resiliency against a severe commodity price shock.
And what about buybacks?
On the buyback front, TPL was historically a cannibal, efficiently buying back shares when they were cheap. But they have dramatically slowed down buybacks as the valuation has expanded.
Right, above 300 a share.
They are demonstrating genuine discipline by refusing to overpay for their own stock. This is a sign of management alignment, even if the market temporarily rewards less disciplined peers.
That discipline is commendable, but as we established, the market is demanding aggressive growth to justify 45 times earnings.
Yes, it is.
So let's shift to the narratives the market is using to justify this growth premium. What are the core growth engines priced into TPL today?
The core, most reliable growth driver is the water services and operations segment. Crucially, this revenue stream is growing faster than the oil royalties themselves.
And this is what transforms TPL from a simple royalty collector into a full-fledged logistics provider.
Exactly.
Why is water growth accelerating so much faster than oil output growth?
It's a function of geology and the life cycle of shale wells. We need to talk about water cut increases.
Okay.
When an E&P company first drills a shale well, it produces a high percentage of oil and a relatively low amount of water. That's a low water cut. But as the well ages, and shale wells have notoriously steep decline curves, the ratio shifts dramatically. They start producing less oil relative to massive amounts of produced water.
So the water cut increases over time.
Dramatic.
So the natural aging process of the basin is actually a geometric tailwind for TPL.
It is, exactly. Since TPL gets paid for both sourcing water for the initial fracking and, crucially, disposing of the ever-increasing produced water from aging wells, this natural basin maturity is a massive and persistent tailwind.
So the more mature the basin gets,
the more water TPL handles and the more fees they collect. The land is transitioning from just an oil collection utility to a full-service water logistics utility.
which is less dependent on the price of crude itself.
That's the key.
That structural growth is one thing, but there is a newer, much more speculative narrative layered on top of this. The one that captures the imagination and pushes the multiple higher.
The call option on data centers. This is where the story gets modern, and this is the fuel for the reflexive bubble argument. TPL owns vast amounts of surface area arid land that historically was only worth ranching or grazing.
And now they're exploring leasing this surface area for high-value compute real estate.
Massive data centers, crypto mining facilities, AI infrastructure.
And they are leveraging the unique combination of the massive surface area and cheap, often stranded natural gas available in the region for power.
Precisely. The Permian has abundant, cheap, and reliable natural gas, which can be harnessed to power these facilities on site.
So they're combining the land with cheap power.
By combining the vast available surface area with cheap, reliable power, TPL is positioning itself as a potential infrastructure provider for the AI and compute boom. The market views this as a powerful, non-core call option.
So it's the story of TPL turning historically low-value ranch land into potentially high-margin technology infrastructure assets.
Offering an entirely different growth profile, completely decoupled from the oil price cycle.
Okay, let's put these pieces together. We have the ultimate geographically cornered landlord generating software-like margins with disciplined capital allocation and a new call option on AI. What does the current 45 FPE multiple imply about the market's collective wager?
The market is pricing TPL not as a cyclical energy stock and not even as a typical utility. It is pricing TPL as a utility-scale luxury good.
A luxury good, like Hermes.
In a way, irreplaceable, perpetual, and immune to recession, almost like a piece of essential economic infrastructure that will exist forever and always command a toll.
Okay, so what are the two simultaneous, massive, and frankly, potentially heroic beliefs an investor must hold to justify this price today?
First, they must believe that oil prices will stay elevated, specifically above $70 per barrel, indefinitely.
Indefinitely, not just for a year or two.
Permanently. If oil prices normalize lower to 50 or 60, the current earnings power that generates that multiple is immediately threatened.
Okay, that's belief number one. What's number two?
Second, and arguably the more speculative belief, they must believe that TPL will not only successfully capture 100% of the water logistics market within its acreage,
Which is a huge assumption.
but that the growth trajectory of the water and, critically, the data center segment will persist at high double-digit rates for a decade or more.
Both of those assumptions fly in the face of history, especially the idea of indefinite commodity price stability.
They do?
That brings us to the valuation reality check. Let's triangulate the intrinsic value for the listener so they can visualize the risk-reward ratio here. We should acknowledge the current price is approximately $312 per share.
We must establish a range of possible values. Our analysis starts with the simplest check. Model 1, historical mean reversion.
Okay, so what does TPL look like if it simply reverts to its long-term average multiple, if that scarcity premium fades just a little bit?
If we take TPL's 10-year average PE multiple, which is historically around 35 times, and we apply it to a reasonably generous 2026 estimated earnings per share of about $7.15,
Where do we land?
the intrinsic value estimate lands around $250 per share.
So that suggests over 20% downside just if the multiple moves back to its historical average.
Just a simple reversion to the mean.
Model 2. Let's look at the external short-term view. What is the analyst consensus?
The average of recent major bank targets tends to cluster around $320.
So basically right where it is now.
Exactly. This is the external market-supported ceiling. It tells us that current analyst expectations are largely priced into the stock already, offering very little room for upside surprise. You are paying exactly what the street thinks it's worth.
And finally, the owner earnings, or discounted cash flow perspective, the DCF model. This is perhaps the purest measure of what the underlying cash flows are worth today.
It is. This model is critical because it forces us to quantify the implied growth rate. And even when assuming highly optimistic growth rates,
How optimistic?
we used a 10% growth rate for the next 10 years, followed by a conservative 3% terminal growth rate. Even with those assumptions, the DCF calculation suggests a value closer to $210.
Let's break down those DCF assumptions for the listener. Why use a 10% weighted average cost of capital, the WACC? And why is 10% growth for a commodity business considered highly optimistic?
We use 10% WACC as a standard hurdle rate for a high-quality asset like this. It reflects what a rational long-term owner would demand for the risks involved.
And the growth rate.
As for the 10% growth rate, that is aggressive. TPL's growth hinges on two things: sustained high oil prices and massive volume increases from the Permian and the water segment.
And the oil component alone is unlikely to grow at 10% for a decade.
Unlikely due to geological decline curves. Therefore, that $210 figure is essentially the best-case fundamental scenario before we account for the speculative narratives.
So if we look at that range from 210 on the conservative high-growth DCF model to 250 on historical mean reversion, the buy zone is clearly established between $210 and $240.
Absolutely. The conclusion is stark. The current price of roughly $312 offers absolutely no margin of safety based on fundamental conservative cash flow analysis.
So the stock is pricing in perfection.
Perfection plus the successful execution of multiple high-risk growth options like the data centers.
This necessitates the red team challenge. Let's introduce the bear case and what we call the kill shot. What are the critical risks that could shatter this premium valuation?
The first, most immediate risk is simple valuation compression tied to the commodity cycle.
Of course.
If oil prices fall sharply, perhaps due to a global recession, TPL's immediate earnings power drops significantly.
And the multiple follows.
If the 45 times multiple contracts to even 20 times PE, which is still a very high multiple for a pure energy cyclical, the stock could easily halve from its current level.
Wiping out 5 years of potential earnings growth in a single quarter.
It's a massive embedded risk tied directly to the price of a barrel of crude, something management has absolutely no control over.
Okay, risk number 2.
The second major risk is regulatory, specifically around seismicity. This directly attacks the water services segment, which is TPL's most consistent growth engine.
The earthquake risk again.
There is rising scientific concern linking the massive volume of produced water being reinjected deep underground, the core of TPL's disposal business, to an increase in seismic activity in West Texas.
And if regulators step in and decide that the injection volumes are too high or mandate shutdowns of disposal wells, TPL's water monopoly takes a direct, potentially devastating hit.
Imagine if the state of Texas suddenly told TPL they couldn't charge a toll on the main highway. How instantly would their pricing power evaporate? It would be catastrophic. The pricing power is directly linked to the producer's regulatory need for reliable disposal.
So if TPL's wells are shut down or limited, the competitive advantage is immediately eroded.
Gone.
And then we get to the core critical challenge, the philosophical contradiction, what the analysis terms the terminal value trap.
This is the ultimate long-term challenge to that 45x multiple. You are paying 45 times earnings for what is fundamentally a depleting asset.
Right, while the land itself is infinite.
The underlying oil and gas, the engine generating the cash flow, is not. Shale is characterized by steep, accelerated decline curves, meaning every barrel produced today reduces the remaining inventory available for tomorrow.
This forces us to ask the inversion question. What happens if Permian production volume peaks in, say, 2027, just a few years out, and enters a structural decline phase?
If volume plateaus or begins to decline structurally, TPL loses its growth premium instantly. A company that is purely based on royalties from a declining asset. Well, it should trade based on its yield, like a bond.
Which would imply a much lower multiple.
It suggests a yield closer to 5 to 7%, which translates to a PE multiple of 15 to 20 times.
But the current price implies TPL will grow earnings at 15% or more for another decade, contradicting the geological reality of mega basin depletion rates.
Yes. The synthesis of the bear case is powerful. The market is currently buying a cyclical liquidation vehicle, an asset tied to the eventual depletion of an oil field, and pricing it exactly like a capital-light exponential software monopoly.
The price fundamentally contradicts the physical reality.
The market has confused scarcity, which TPL has, with perpetuity, which geologically it does not.
This deep dive has presented us with a fascinating complex paradox. We have an elite quality score, an unreplicable moat, pristine FCF conversion, and disciplined capital allocation.
All true.
But that is measured against an extremely expensive valuation score that prices in every potential upside and discounts every conceivable risk.
The decoupled price is driven almost entirely by the optionality narrative, the data center dream, and the water monopoly certainty. The business quality is truly A+.
But the investment price?
The investment price is objectively dangerously high. The market has priced in the capture of all current upsides and several highly speculative future options.
So the key takeaway for you, the learner, is clear. TPL is a textbook example of a phenomenal, best-in-class business that may be a disastrous investment purely due to its price.
And the unsustainable growth expectations embedded in that multiple.
For an investor to succeed at $312, TPL doesn't just need to execute well on water. It needs to achieve geological, political, and technical miracles with the data centers, while oil prices remain elevated forever.
Something to mull over as you do your own analysis. The scarcity is real, but so is the price of that scarcity.
That discussion about the terminal value trap raises an important final question for you to explore as you consider this sector. In a world shifting toward renewables and with increasing political pressure on fossil fuels, how much are you willing to pay today for a 100-year hold on an asset whose value hinges on a potentially accelerating geological depletion curve?
Are the data centers truly enough to offset the eventual inevitable plateau of the Permian Basin?
It's a tension between physical reality and financial narrative that will define TPL's success for the next generation.
It's the ultimate lesson in the difference between a great business and a great investment. We appreciate you joining us for this deep dive into one of the most intriguing and contentious assets in the market today.
We'll catch you on the next deep dive.